Welcome to this Executive Explainer. Today, we're going to decode the strategic intelligence behind OPEC Plus's pivot to cautious, monthly output increments for 2026. Now, if you're a B2B energy leader, this Project 54 briefing is absolutely essential. We are looking at a fundamental shift in how the cartel manages the global oil supply. And honestly, understanding this pivot is your key to navigating the highly volatile markets we have ahead of us.
Okay, let's take a quick look at our briefing roadmap. We'll be covering the strategy of monthly increments, balancing market share and price, the Strait of Hormuz fog, the reality of spare capacity, cartel discipline through compensation, and finally, navigating post-disruption markets. All right, starting right off with Section 1, the strategy of monthly increments. We're going from big tranches to a monthly dial.
So just think about the stark contrast here between the rigid, predictable supply drops we saw in 2025 and the highly cautious, optionality-preserving cadence they're setting up for 2026. Through 2025, the market pretty much knew the exact path, right? OPEC and its partners were unwinding a 2.2 million barrel per day voluntary cut in these large, pre-scheduled steps. But in 2026, the strategy completely transforms. The group has explicitly stated that they're retaining full flexibility. They want to be able to increase, pause, or reverse the phase-out based strictly on evolving market conditions. This change in cadence, it isn't just administrative housekeeping. It is the entire strategy. And the really crucial metric here is this specific figure, a highly measured 188,000 barrel per day adjustment for July. This allows the cartel to turn the dial up, hold it steady, or reverse it based purely on market signals. By doing this meeting by meeting, rather than relying on some rigid long-term schedule, they've essentially replaced a published calendar with a monthly dial. Moving right along to Section 2, balancing market share and price. These are two goals that pull entirely against each other. The cartel is walking a massive tightrope here. They're trying to aggressively reclaim market share from competitors, but without flooding an already fragile market and completely collapsing the price. It's a tough balancing act. On one hand, since late 2024, Saudi Arabia has signaled a really clear push to retake share, specifically aiming to curb investment in competing U.S. shale. But on the other hand, the international energy agencies out there explicitly warning of a massive projected oversupply for 2026. If OPEC returns barrels too quickly into that kind of environment, it would absolutely crater the price. Which brings us to Section 3, the Strait of Hormuz fog, the unpredictable disruption. You know, right now, there's this huge geopolitical blind spot hanging over the market. A disruption in the Strait of Hormuz is completely masking the true supply and demand balance. We're talking about a choke point that normally handles around 20% of the world's oil. With these flows bottlenecked, any barrel you add on paper might not actually reach the physical market. That makes long-term planning virtually impossible, and it's actually a primary driver behind their new, cautious month-by-month approach. Jorge Leon over at Rystad Energy, he's a former OPEC official, by the way, issued a really stark warning about this. He pointed out that the market is currently priced for a scarcity that could literally vanish overnight. As soon as that vital strait reopens, we aren't just looking at normalized flow. We're looking at a market violently swinging from a fear of shortage right into a fear of surplus. Let's dive into Section 4, the reality of spare capacity, notional versus real barrels. Halima Croft at RBC Capital Markets points something out that completely blows up a common industry assumption. We tend to think that a group quota increase automatically equals a massive surge in physical supply. But the genuine spare capacity in the market isn't evenly distributed across the cartel at all. It's heavily concentrated in a single country. So we have to remember that quota increases do not automatically equal wet barrels on the water. Because most other member states are already producing at their absolute maximum capacity, a communiqué saying they're raising quotas by 188,000 barrels doesn't actually mean 188,000 fresh barrels are hitting the water. That burden leans almost entirely on Saudi Arabia. For B2B energy buyers and suppliers, it's crucial to realize these announcements are partly notional. They act more as a signal of intent, a tool for managing market psychology rather than a precise supply instruction. Okay, Section 5, cartel discipline through compensation, enforcing quotas quietly. The real key to understanding cartel cohesion right now is this somewhat unglamorous tool called the compensation mechanism. Rather than letting persistent overproducers like Kazakhstan and Iraq fracture the group, OPEC Plus requires them to front-load cuts to make up for those past excesses. Think of it as a strict internal audit system, and it's going to be rigorously monitored by the Joint Ministerial Monitoring Committee right through the end of 2026.
This mechanism is basically the glue holding the whole operation together. It allows OPEC Plus to show a unified front and quietly absorb shocks, like the UAE's structural departure, without completely splintering. It enforces much-needed discipline without sparking a public, market-shattering confrontation. And practically speaking, it actually offsets some of those barrels being returned through the small monthly increments. It's what gives the group's headline policy its actual credibility. Finally, let's look at Section 6, Navigating Post-Disruption Markets. What actually happens when the disruption clears? If we pull back and look at this matrix from Project 54, you get a really clear blueprint of the operational shift. It perfectly synthesizes how the cartel has traded committed paths for cautious optionality. We're moving away from the rigid pacing and monitoring of 2025 and stepping right into the highly flexible, cautious, and front-loaded reality of 2026.
But here's where the real danger lies for corporate strategists. It's the latent supply waiting in the wings. We've already talked about that massive fear of surplus repricing risk waiting for the Strait of Hormuz to clear. But beyond that, there is a parked secondary tranche of 1.65 million barrels per day in voluntary cuts. It's just sitting there, completely parked, waiting for the cartel's monthly green light. Because of this, market price visibility is incredibly poor right now. If your company relies on a specific oil price band, like, say, Equinor does with its price-anchored buybacks, well, you are now essentially taking an involuntary position on OPEC's monthly board meetings. Which leaves us with this final provocative thought. It's the ultimate swing factor for 2027 that every energy leader needs to be prepared for. When that geographic bottleneck finally clears, how, and exactly how fast, will OPEC Plus unpark those 1.65 million barrels? That decision will dictate the entire future of the market. Thank you so much for joining me for this briefing, and definitely keep a close eye on those monthly dials.